Hello, everybody. Welcome to the College Financial and Merit Aid webinar. I'm David Haas. I'm a certified financial planner from Cereus Financial Advisors, and I'm joined by Michael Dunn, um, another certified financial planner from Cereus Financial Advisors. I'm we're going to go over this material. We have quite a few slides, and if you could put any questions into the chat, that's the best way to do that. In fact, let me write a message there. Um, but after the end of the material, if you want to ask questions live, you'll be able to unmute yourself and do that if you want to. So let's start. So at Cereus Financial Advisors, we have a service which we call College Money Match. We help you navigate college finances, and our goals, hopefully, are the same as your goals. We want you to pay less for college. We want you not to get into too much debt. We want to maximize aid, and we want you to understand how much each college might cost before applying. And we want you to create a plan to pay for your entire child's undergraduate education, not just the first semester. And we really don't want you to be paying off your child's college expenses during your retirement. A little bit about me. I founded Cereus Financial Advisors in 2015. This is my second career. I started off as an electrical engineer, although I do have an MBA in finance and studied for the CFP. And right now I'm president of the Financial Planning Association of New Jersey. So I will tell you that if my expertise and our expertise actually is, on the finance side. But if you want to ask questions about engineering school, I can answer those. I know a lot about the schools that teach engineering. And I put my own two kids through college, Gettysburg and Syracuse, and didn't do it perfectly on the finance side. So some of these things that I'm going to tell you, I wish I knew. And now I'm going to have Mike introduce himself, and he's going to start the webinar on talking about needs-based aid.
Thanks, David. Good evening, everybody. Thank you for joining us. So my name is Mike Dunn, as David introduced me. Second career for me also. I've always had jobs in and around finance. I started out as a CPA, went back to graduate school for an MBA in the 1990s. And I think most importantly for our discussion tonight, I've got experience doing what we're going to be talking about as well. My two daughters are both through college and various levels of grad school, including my older daughter who went back to school to study medicine and has recently started practicing as a physician in the Philadelphia area. And if you can call up your imagination for a second and picture yourself in a movie theater. The theater goes dark, and up on the screen there's just a picture of the night sky with stars. And all of a sudden you see these words appearing on the screen. A long time ago, in a galaxy far, far away, and on the next screen, we went to college. So we've been through the process that your students are going through now, and that many of you have gone through. And it was quite a long time ago. And actually, in my case, I grew up in Jersey City, so not that far away. But the process seemed a whole lot simpler back then, in my opinion. It's quite a task that you have to look forward to, and we hope to help you navigate through it. So if you can go to the next slide, please, David. I'm sure you already have a sense of this. Perhaps just to put the the upcoming expense of college in perspective. Here's a comparative display of larger ticket items that you'll encounter in your lifetime or that you've already encountered in your lifetime. Buying a car, price has gone up. But that's the typical price of a Honda CR-V hybrid, which David happened to buy one in recent couple of years. In nearby Waldwick, New Jersey, nearby to our Franklin Lakes office, that is. Here's an indicative price of a 3-bedroom, 2-bathroom house, $550,000. And given the state of the housing market, probably it has a number of offers on it that are over the asking price. Comparatively speaking, the price of 4 years at NYU using this year's tuition and room and board and projecting that out 4 years, as you can see, is nearly like taking on the idea of buying another house for yourself. And that price has gone up from just last year. And then finally, on the far right, a well-regarded public university, especially for very desirable for New Jersey residents, is the College of New Jersey. And you can see the sticker price listed there being ballparkish about half of what NYU would be. But even so, that price has increased quite a bit in the past year or so. So you're taking on quite an endeavor, and we hope to give you some tips to make it as painless as possible, if that's possible. So why has college gotten so expensive? Well, for one thing, state governments particularly provide a lot of support to public universities, but public universities then are competing with private universities as well for students. And with their budgets having gotten tighter over more recent years, the amount of money that they can allocate towards supporting state universities has been reduced. At the same time, administrative costs at the universities have gone up quite a bit. And many colleges have spent money to upgrade infrastructure like dorms and athletic facilities to make themselves more desirable to students. So the burden has shifted a bit more onto families and students from what had previously been covered by, at least partially covered by state governments. Perhaps more subjectively, college is also expensive because some people are willing to pay that much. And we'll talk about what we mean by that in a couple of minutes. It's also difficult to understand how colleges build costs into the amount of tuition that they charge. There isn't very much transparency, so it's a puzzle that we try to poke holes in and try to get a better understanding of how they work. The good news is, despite all of these expenses, according to a recent survey, close to 90% of students who chose to go to private colleges got some form of financial aid. This is data back from 2019, 2020 or so. So next slide, please, David. So perhaps a different way of looking at how to pay for college is perhaps thinking about buying another big ticket item. And I don't know, let's say choose the cost of a car, perhaps, as an example. You see the sticker price listed, posted on the inside of the back window. And typically you'll want to take advantage of a sale. Let's say there's a dealer incentive, other motivators to offer the buyer perhaps some credit or some discounts to induce them to come in and look at buying a car. In the college case, that comes in the form of financial aid for needy families, what we'll refer to in this webinar as needs-based aid, needs-based financial aid. Um, and also there are discounts for some who perhaps have the ability to afford college a little bit better than families with financial need. And that's merit aid and merit scholarships. So you start with a sticker price and subtract out these discounts and come to a net price. Um, and as we allude to in the bottom of the screen here, similar to airline pricing with demand, depending on when you bought your ticket, you may have paid a lot more or a lot less than the person sitting next to you on the plane. Um, Depending on your family's and students' package of academic ability and financial ability, colleges will customize a net price for you that may not compare with the net price that other students that they enter school with will have been charged. Next slide, please, David. So the rest of this webinar is going to focus on or be structured in a way that I'll cover the first part, financial aid for needs-based financial aid, which is mainly formula-driven. And in the next couple of slides, we'll do that. Following that, I'll turn it over to David, and he'll discuss scholarships and merit aid, as well as student loans and a few other things. David, at this point, we added a new slide in the presentation, and I want to refer to it real quick. I believe it's slide 17. Why fill out the FAFSA? Why you need to fill out the FAFSA. So among the lessons that I wish I knew when I was financing college for my daughters, and I'm sure David may have similar sentiments as well, my wife and I happen to have worked very hard over the years and put away a lot of savings. And we just thought, well, what's the point in us filling out this form? We're not going to get any financial aid. And in that statement, what I mean is we were probably not going to qualify for needs-based financial aid. But really, filling out the FAFSA is where everyone should start. And these are the reasons why. Because you want to be considered for financial aid, and yes, that would be needs-based at least at the outset. However, if you don't qualify for needs-based aid, you still need to fill out a FAFSA in order to qualify to receive federal student loans, which are not needs-based. There are certain types or certain eligibility in terms that will make it more affordable for people who need financial aid versus those who can afford it. Yet, federal student loans are a very good deal, which David will talk about further on in the presentation. And you don't qualify to even consider whether to borrow those unless you fill out the FAFSA. Because you want a better merit aid offer, believe it or not. And David will talk about reasons why that might work. And perhaps also because you think it will help you get into the college in the first place. The more colleges know about the student's profile and the parent's profile may make them more desirable. And that part of it probably has more to do with merit aid, which David will talk about a little bit later on. But when we refer to the FAFSA, it's the free application for federal student aid. And now if we can go back to the, I believe that's, yes, slide 9. So to fill out the FAFSA, it starts with parents' financial information, and that's going to be most of it, including tax returns. It's very formula driven, as we've mentioned. So the process has changed such that a lot of the information that will automatically populate into the FAFSA, assuming you agree with this, is that it will be uploaded from the most recent tax return federal income tax return that you filed. And let's call it somewhat of a black box, will determine, based on the financial information provided by the parents and the student, they'll come up with a concept of what they think you can afford to pay. That used to be called the expected family contribution, or the EFC. They changed the name, but it's essentially the same kind of concept. It's now called the Student Aid Index. Interestingly, they're happy to tell you what they think you can afford, which probably won't be the same idea that you might have about what you think you can afford. And typically, this will determine an amount of financial need. And generally speaking, colleges won't meet 100% of financial need, but they may meet a substantial portion of that. As an example, for Gettysburg College, the estimated cost of attendance for this current academic year is a little over or close to $86,000. Um, and a typical offer would meet 90% of need, a family's need. And of that amount that it meets, they offer nearly all of it in the form of grants, 91%. So financial aid comes in many forms, as you may know. It comes in grants, which are the best because you don't have to pay them back. Loans, which can be okay. You do have to pay them back, but terms, depending on the ones the type of loan that you sign up for, can be very helpful. And work study, where a student gets a job on campus and that is used toward the cost of tuition and room and board. So the aid can come from the federal government, can come from state governments, or it can come from the school itself. And the thing about needs-based financial aid is that you have to apply and reapply each year. So apply first before freshman year, and then each year rolling forward, you have to refill out the forms with updated information and apply all over again. So when you complete the financial aid forms, the FAFSA in particular, schools operate using two financial aid calculation methods. The federal method, which is used by many public universities, state universities, and the institutional method, which is used by many of the private universities and private colleges. The FAFSA is the starting point. It determines the expected family contribution or the student aid index, as I just described. Normally, it would be available October 1st. So if you have a student entering college next fall, you'd be looking to fill out the FAFSA this fall. Typically, the FAFSA form, which you can do online, will be made available by October 1st. However, in the last 2 years, FAFSA made a number of changes, not only in terms of what they look at in terms of families' financial situation, but they also changed the methodology by doing a lot more of an upload from federal income tax returns. And the process of changing, in the process of changing, they've run into a number of hiccups that have caused delays. So where it normally would be available this year as of October 1st, I believe it won't be available now until December 1st. But as mentioned, you need to fill that out, even if you don't think you qualify for needs-based aid in order to get access to the federal student loan program. What the federal method looks at, or what they don't look at, we'll start with that. They don't consider the value of parents' IRA accounts, 401ks, or the value of their home. And a new wrinkle for 2024, they didn't look at the value of a small business if the parents owned a small business, but they've changed that, and now they do ask you for the value of a small business that the parents may own. In contrast, the institutional method, the one that the private universities use, they require another form on top of the FAFSA called the college, the CSS profile, which is from the College Scholarship Service. From the College Board. Each university takes the information, and there's no standardized process that all of them use. In other words, each of them make up their own formula as to what they think is important to include in determining whether a student and their family qualified for needs-based financial aid. So the schools, in contrast to the public universities, in contrast to the federal method, the schools will look at the value of parents' IRAs, 401ks, annuities, the value of their home, net of their mortgage, so in other words, the home equity, and they will look at the value of a small business that the parents may own as well. And the black box here, it's a red box, but just for presentation purposes, We don't get full transparency into how the FAFSA and the federal method formula works, but generally speaking, it falls into these ranges. Um, so financial needs-based financial aid is dependent mostly on evaluating the level of parents' income and students' income. So providing all of this information about your financial situation, the formula will give the highest weight to parents' income, and the amount of weighting that they give is anywhere from 22% to 47% that they will consider for inclusion in what they think you can afford to pay. Secondly, they'll look at students' income above an allowance. So a student can work and have a part-time job. If they make over $11,130, 50% of what they make is considered fair game and what the colleges would expect a student to contribute toward the cost of their college education. Um, Also, student assets are, I won't say penalized, but they're weighted at a higher level than parents' assets. So if students have a significant amount of investment assets in their name, 20% of that would be counted toward what the formula would consider to be part of the expected contribution from that student to pay toward their college education.
Hey, Mike.
Yes, David.
I just wanted to point out, just to make it clear, that these numbers are for dependent students. So an independent student, which would be one that doesn't have, isn't dependent on their parents, um, really there's different formulas for that.
Mhm. Thank you. Um,
And we've had a couple questions, which maybe we can just quickly answer.
sure.
So Ramona's asking, how can parents find out how much loan debt students will graduate with at a particular college? And I'm sorry, this is a softball to us. By using our service, we can forecast that. But the answer is really that the colleges don't know, because it all depends on what the parents' budget situation is. If you were saving in a 529 plan for your kids from birth and, had a lot of their college paid for, then they don't need loans, no matter how much the college might cost. But most people have not saved that much, and then they've got to figure out a way, the family has to figure out a way of paying for it. And loans is one way of paying for it when you don't either have the income or the assets. So the answer is it depends, and we can forecast that for you using our tools.
Yeah, and there's actually David will cover a case study or two further on in the presentation that illustrates how that can be forecast. So there are two student examples, and their family financial situations are different, and we can illustrate kind of what our software will show about that in terms
Right.
of what they may need to borrow and how much it might cost, and comparing different schools that they apply to, which makes more sense to apply to, what's the sort of better financial fit for a student and their families at particular schools.
And there's one other question Ramona had. How is the number of dependents in college considered? And actually, today, the federal method does not consider the number of dependents in college. So it doesn't matter if you have, 10 children and 10 of them are in college at the same time. That would be unlikely, but, maybe you had a couple sets of quadruplets. Um, it doesn't matter. The formula does not consider that. However, at private colleges, the CSS, most private colleges will consider that. So this is a case where if you do have multiple dependents, you might actually do better at a private college than a public one. Anyway, sorry to interrupt. Let's
Yeah, no worries. So that
let's
and
go on.
that last point was the most unfortunate change um, made by the new FAFSA process because they changed what they used to evaluate in terms of a student's eligibility, and they used to give you credit for having more than one child in college at the same time, and unfortunately, that was taken away, and for a reason that probably doesn't make any sense. But unfortunately, that's the way it is at the moment. So actually, just to finish up on the previous slide, the third point was that parents' assets are weighted at a very low weighting of only just less than 6% in terms of calculating the expected family contribution or the student aid index, and that includes the value of 529 plans. So sorry, now you can continue with the next slide. So families with divorced parents are more of a special situation. Previous to this academic year, the federal method would look at the income and the assets of the custodial parent only. Among the changes that the new FAFSA process brought about is that they now look at the parent who pays the most towards a child's upkeep or support. That's for, remember, this is the federal method, which is used by most public universities. For the institutional method schools, generally private universities, they already look at the income and assets of both parents, whether together or divorced. This leaves some room for interpretation in this in the case of divorced parents. Because they're not going to know who really pays the most for a student's support and upkeep. So if it's possible, if the parents can work together, choose the lower earning parent and provide that information on the FAFSA. And it used to be, and this is a positive rule change in FAFSA considerations. It used to be that the custodial parent would receive child support payments, and that would be counted as income, which would be weighted very heavily in the expected family contribution calculation. Now it's not counted as income anymore; it's counted as assets, and will only receive like a 5 or 6% weighting. So, so that is a much better situation for couples in that predicament. And for federal method schools that evaluate the value of the small business that the parents may own, they'll ask you to provide how much the business is worth, but they don't tell you how to calculate it. So you have to come up with a methodology that makes sense, be conservative, but as long as it's I suppose you make it kind of a standard calculation, whatever it might be. They're going to be very hard pressed to challenge the value that you report for the small business that you own. So I think that's it from the needs-based aid portion of the presentation. I will turn it over to David now for merit aid.
Thanks, Mike. And on the small business, you have to think about valuation in terms of either the valuing of the assets, maybe your small business owns some trucks or something like that. But also think of it in terms of selling it as an ongoing business. So, a business that's completely dependent on the owner, like a consulting business, especially if there's few assets, it's really going to be worth close to zero because you won't be able to sell that business without the owner. So it's fair to really lowball these business valuations. So let's talk about merit aid. You can really think of merit aid as a discount that colleges provide to some students. And these are the students that help the college meet its goals. I call them demographic goals, but it's students at the high end of their academic performance target. The colleges will publish what their target is for standardized test scores and for GPAs, and students who exceed those targets are much more likely to get merit aid. Also, students who are active contributors, leadership positions in clubs or activities, sports or music achievement. And I'm really not talking about, real Division I sports scholarships. Even in Division III schools, colleges need those sports students who are going to participate, and they're going to provide money for the students that they think will participate. Again, not the same thing as a Division I scholarship. Also, nonprofit leadership. There's a lot of high school students who create nonprofits or have nonprofit leadership experience. Great thing to put on the resume. Then there are some geographic goals that colleges have. Um, might be a little bit easier to get in and get some money from a school in Texas if you're a New Jersey student than than if you were a Texas student, perhaps. So if you go far enough away, sometimes that can help you get a little bit more money. And then majors. You know, if you're an English major at an engineering school, you might get a little bit more money because they want some English majors at that engineering school, as an example. And then demonstrated interest to the college. These are all the same things that make you a good candidate for getting into a college. So the things that make you a good candidate for getting into a college make you a good candidate for getting merit aid. You can bargain once you get accepted. So you can write an appeals letter. Now, there has to be good reason for that appeal. So in the case of merit aid, the appeal is either something's changed for the better, otherwise you wouldn't appeal. So for instance, you won or the student won some kind of award, or got much higher grades than they had gotten in the past, or new test scores. So something's changed, and that's a reason for appeal. And you can also bargain based on another offer from a comparable school. So I'll pick Gettysburg again. My daughter happened to go there. One of their rival schools is Dickinson College. If you got a better aid offer at Dickinson, you can bargain at Gettysburg and vice versa. So on the other hand, if you got a good offer from College of New Jersey, which is a public school, that's not going to help you that much in bargaining at Gettysburg. Merit appeals are much more likely at private colleges. Public colleges do give merit aid, but they tend to be a final offer. There are a few exceptions, but and also not that many do give merit aid, but for the ones that do, it tends to be a final offer. The nice thing about merit aid is that it's usually renewed automatically. You don't have to reapply. Sometimes students may have to meet academic goals in college. It used to be a 3.0 or better average was kind of the standard, but today they've really reduced that to maybe 2.6, or eliminated it completely, because they don't want to put as much pressure on the students losing their aid.
David, while
Yes.
we're on the topic, Eva asks, how would you know that the merit aid was awarded for various achievements? And additionally, how can you tell if the merit aid was awarded for playing a sport in a D3 school?
Honestly, you couldn't. They're not allowed to give scholarships for D3 schools specifically for sports. I'm just telling you that they do. So they're not going to tell you what the scholarship was for, unless they do sometimes have restricted scholarships. These are almost all academic. Um, Sometimes the scholarships are, well, I shouldn't say they're all academic. Some of them may be for music or art, particularly if you're going into a music or art program. In that case, you're submitting a work of art, or a portfolio, or you are having an audition. And there are scholarships that are specific to that. But otherwise, the scholarships are sort of general, and you're not really going to know why your student is desirable. Um, so families need a 4-year budget. This is very important. College is a financial commitment for at least 4 years. And I say at least because Rutgers, New Brunswick in 2020, their 4-year graduation rate was 66.8%. So now, that's not necessarily a bad thing. Sometimes students go in co-op, where they're working during the school year, or there are other reasons why they don't graduate in 4 years. It doesn't always mean a bad thing, but what it does mean is that sometimes you're paying for extra time that you didn't expect to. And you do not want a 100K or more debt for your degree. I would say, particularly if you're planning on going to onto an advanced degree. Actually, I was just at a conference this past week where I was listening to information on dealing with student loans for newly graduated doctors, and some of them have $300,000 or more of debt, because it takes so long to go for a medical degree. And that might be the extreme, but there are other advanced degrees that do take a long time and cause a lot of debt. So undergrad is where you can start minimizing that if you are planning on going on for graduate degrees. And I highly recommend that your student is part of the financial process from day one. Frankly, if you have a budget, you want to temper expectations. You want the student to understand how paying for college is going to affect them and affect you. And the truth is that nowadays, students usually cannot afford to go to any college they want. So the financial part of the equation is at least as important as the academic. We talked about the FAFSA, so I'm not going to go over that again. Let's talk about loans. So federal student loans are probably your first step, the first place you want to go. Unfortunately, they are capped. And while college costs have kept going up, the cap on the loans has not changed for a long time. I don't know, something like 10 years. So freshman year, the loan is capped at $5,500, and it goes up to $6,500 sophomore, and then $7,500 after that. This is for undergraduate loans. There are two types: subsidized loans and unsubsidized loans. The only difference is that for subsidized loans, they are interest-free while in school and for 6 months thereafter. For unsubsidized loans, the interest accrues from day one, but it's deferred into the loan. One of the reasons why these loans are your first place to go is that they are eligible for income-driven repayment plans, discharge on disability or death, and whatever loan forgiveness programs that are not struck down by the Supreme Court. There are some that are actually written into law, like the Public Service Loan Forgiveness Plan. And there is actually some other loan forgiveness based on the income-driven repayment plans that is also written into law. At the moment, federal student loans are 5.5%. If your student is a senior in high school, the rate is going to be set June 1st of 2025 that you would borrow at. And every year the rate changes. The next loan I'll talk about is also a federal loan. It's a federal Parent Plus loan. At the moment, it's 8.05%. I'm thinking it's higher than that. I wonder if this is an old figure. I'll have to check on that. It's high. Anyway, it's high. It depends on credit score, not income. And I'll also point out that the federal student loan, the first one I talked about, that's the student's loan, and the parent is not a cosigner on that. Now, the federal loan is a parent loan. There's no maximum, and it is eligible for an income-driven repayment plan if it's consolidated. But basically the loan, will stick around for a long time. It is eligible for public service loan forgiveness. This is for the parent, if the parent works in public service. But I believe that they are actually changing that. So I wouldn't count on it. I will point out that federal loans are often not discharged in bankruptcy. So you would have to go bankrupt and be maybe disabled, where or they'll know that you're never going to work again, you're never going to earn any income. Then it can be discharged. But if you will just go bankrupt but continue to work, that loan is going to stay with you. But there's some other loans available to you. One of them here is the NJ class loan. Yeah, now that I'm looking at that, I apologize. I thought I had updated this slide. I think the federal parent loan is over 9%. I think it's 9.05. That might be a typo. I apologize. The NJ class loan is available to students who live in New Jersey or are going to a New Jersey state school. New Jersey happens to have a pretty good student loan program, state student loan program. The student or the parent can be the borrower. The rates are lower than they are with the Parent Plus loan. And there is a credit check and income verification. There is an income contingent repayment plan. The loan is discharged on death or disability of the student. So I actually prefer these loans to the Parent Plus loans in a lot of cases, if you need more than the federal student loan. New York does not offer a state loan program. Connecticut, Massachusetts, and Pennsylvania do. Massachusetts is a good choice for New York students because they don't require you to be a resident or go to a Massachusetts school. Anybody can use the Massachusetts loan program. I think New Hampshire also has one that anybody can use as well. So the other choice is a private student loan. The rates will vary. In that case, the student is usually the borrower with a cosigner. Terms will vary. They're often not dischargeable on death or disability. Certainly, if you get a private student loan, you'll need to get some life insurance in order to cover the student for death. Of course, you don't have to use student loans. You could get a home equity loan, which is going to be at a lower rate, but of course you're putting your house on the line for the college education. And there's certainly other forms of borrowing. You could borrow on a second home. That will probably give you a lower rate as well. And I will point out that you can borrow $50,000 from your 401k plan. It's 50% of the plan over or up to $100,000. So 50,000 is the most you can borrow from the 401k plan. In that case, you are paying it back to yourself, and you do have to pay interest, but you're paying that interest back to yourself. So college choice is very important. The more prestigious the college, the fewer discounts that they will provide. The most academically rigorous colleges, the Ivies, colleges like MIT and Stanford, they don't give merit aid at all. So you have to go slightly under. Again, I know a lot about engineering schools. So, you might not get merit aid from an MIT, but you're going to get merit aid from Rochester Institute of Technology, Stevens, Rensselaer Institute, Rensselaer Polytechnic. They will provide merit aid. And many of these colleges also have honors colleges, so they want the more academically gifted student, and you'll get a very good education there. So at College Money Match, we help you predict the financial aid and the merit aid. We do that by collecting your financial information, collecting the information, academic information of the student, and we have a listing of every merit scholarship that colleges have in our software. So forecasting is even more important this year because the FAFSA is going to be in December. So even if you apply early action, you're not going, you may find out you get in, but you may not get an aid offer until after December. Apply early action. Early action is great, but avoid early decision if you want a good offer. Because early decision is binding, the colleges are often not incentivized to give you a good aid package when you apply early decision. Of course, you can still turn down early decision. You're asked to agree that you will go if they let you in, but if you really can't afford it, you can turn it down. All right, and I talked about budgeting. So let's go to this case study because I think it will be helpful. So the student is Malcolm. Parents are John and Esther. John makes $140,000 a year. Esther makes $30,000. They've, saved money. They have a home equity of $300,000, $155,000 of savings and investment, and $355,000 in retirement accounts. Malcolm is going to be a high school senior in 2025, and he has a sister who's in the class of 2027. And Malcolm is smart. He's got a 3.95 GPA and got a 34 on his ACT, and he wants to study English. So hopefully everybody can see this. This is some of the output from the software we use at College Money Match. And ignoring the first line, which is Bergen Community College, we can talk about Brown, which is an Ivy League school. Gettysburg, I like to pick on Gettysburg. Marist College, College of New Jersey, which is a New Jersey State college, and Malcolm happens to be a New Jersey resident. University of Alabama, out-of-state school. Great if you want to watch football. University of Delaware and University of Rochester. So the cost of attendance is the first column, and you can see it goes from a high of 97,310 to a low for College of New Jersey of 41,777. Again, ignoring this first line. The SAI is the Student Aid Index. So this is the forecast of the Student Aid Index, and you'll see an F or an I afterwards. F means it's the federal method. I means it's the institutional method. So with Brown, the SAI is only 19,500. They use the institutional method. At many of the other schools, it's it's in the 30s. So cost of cost of attendance minus student aid index equals need. So the next column is need. That's how much money the college thinks you need. And the next column is the institutional need-based grants. So Brown, which really tries to meet 100% of need or close to 100% of need, and in this case, it will be 100% because when you throw in the subsidized loan, it will meet 100% of need. They're going to give the most, 74,690. Um, some of the colleges, particularly the state colleges, they don't have very much money for need-based grants. They don't actually fulfill that much of need, although their starting price is lower. The next column over is merit scholarship, and you'll see that Malcolm's a smart kid, and he's going to get quite a bit of merit scholarship. Unfortunately, you don't usually get both the needs-based aid and the merit scholarship. You get whichever one is more. So at Gettysburg, he'd be getting the needs-based grants. At Alabama or Delaware, he'd be getting the merit scholarship. So it's usually one or the other. And your first year net cost is basically, one minus the other. And one of the reasons why I put Bergen Community College is an option is to go to Bergen Community College. And this actually used to be more effective. It isn't 30,000 because most people commute, and that 30,000 includes a dorm charge. Bergen Community has built dorms. So it's really much cheaper than that. It's around $8,000 if you're a commuting student. And that's a good point for some of these other colleges. You could go to a state college near you and you could commute. In that case, the cost of attendance is lower. Okay. So one option is to go to community college for 2 years and then transfer into a 4-year institution. That can be a great option, but you need to be careful because not every 4-year institution takes the community college credits. They have to take the credits. Bergen Community has some agreement with some of the state colleges. I know they have an agreement with Ramapo. So for instance, you could go 2 years to Bergen as a commuting student and then finish up your 4-year degree at Ramapo. And that would be a very inexpensive way, probably the most inexpensive way of going to college. Okay, and we're we're running a little short of time, but I'm going to try to go through this, and maybe we'll go a little bit over. But this is outcomes for English majors. So every school is supposed to publish this information of what they think the first year salary is, and of course, they're supposed to get that information from their graduating students. So here we have the funding gap for each of these schools. This is basically assuming that the entire amount that's not paid for in aid is taking out loans. But of course, that's not always the case. Here's the salary. Here's a calculation of the payment under a 10-year repayment plan. That's a standard repayment plan for the loan. So you can see how much you'd be paying for these loans compared to the take-home pay. And then, we give it a rating. So, Alabama is good, Brown is great. Of course, it's very hard to get into a school like Brown, but of course, students do. Gettysburg is actually good, and Bergen Community is ideal. um, just to go over again some of the FAFSA changes that have recently occurred. They were actually, most of them were first instituted last year, so we're on year 2. They were part of the CAA Act of 2021. We already said that it used to be called EFC, and now what you get out of the FAFSA is called SAI. One thing is that the SAI can be negative. If you are below the poverty limit, your SAI will probably be negative. That will actually give you more aid, a higher Pell Grant. The FAFSA form is short. It's 36 questions instead of 100. So data is automatically entered from the tax return. You must agree to this. That is another change. You cannot turn down the automatic data entry from the tax return. In order to be eligible for aid and in order to finish the FAFSA, you have to agree that the information is automatically entered from the tax return. And of course, the shorter questions, it may be simpler, but the questions will require more math to answer. So they're going to ask you, what are your assets? They're not going to divide up the assets. You need to figure out what has to be added up in order to answer the question. We mentioned for divorced and unmarried parents, it's now the parent that provides the most financial support. If it's all even for financial support, it's supposed to be the highest AGI. But again, I'm not sure how this will get audited. I really haven't heard the results from last year. So, and we talked about the discount for multiple children being eliminated. So some additional FAFSA changes. The parent income allowance was increased by 20%. So that means less parent income counts. The student income allowance was actually increased by 35%, so less student income counts. We talked about the small business. We talked about the child support. Clergy and military allowances are now not counted. So this is great if you are in the clergy or military and you are getting non-taxable allowances. That is very, very beneficial for aid. And grandparent or other family monetary support and gifts are now not counted. So if you are lucky enough, or if your child is lucky enough to have a grandparent who wants to contribute to the college education, they can basically gift as much as they want, and it doesn't count towards the aid, negatively towards the aid. And here is the answer to one of the questions that is in the chat. Here is a student, this was in 2021, and I have this in here because, they wrote it up in an article. And so this student went to Harvard and also earned a $40,000 scholarship during her graduation ceremony. This is an outside scholarship. And she, the article was written up because she told the high school to give it to somebody else, and it makes her sound very altruistic. But unfortunately, the outside scholarship would have reduced her needs-based aid, because that's the way it works. If you get an outside scholarship, you are supposed to report it to the school. And the school, if they're giving you needs-based aid, they will reduce the needs-based aid. They're actually required to do so by law. But how they do it is a little bit up to them. And they might be giving you a work-study job, and they might be giving you a subsidized loan. Hopefully they reduce those first instead of reducing the grants first, but some colleges will reduce the grants first. Usually someplace in their financial aid website, they will explain this, how they count outside scholarships. So, how will you pay for college? How can you afford college? Have you incorporated cost into your college search? How much debt will your child be in once they graduate? How will college affect your own retirement? And what if you have more than one child and you have to do this multiple times? So this is where College Money Match comes in. We help you answer these questions. We help you fill out the forms. We're actually not allowed to fill out the forms for you, but the FAFSA, the FAFSA is the one that has the law, but we work with you to fill it out together as part of our service, and we help you forecast the aid. This, which is a little bit hard to see, this is the dashboard in the software we provide. We can see this, you can see this. The College Money Match service is really a mixture of software that you can use and coaching sessions with us. So the details are on our website. And we also have a free giveaway where we have an ebook, which I know is up to date on those student loan figures, which apparently I did not update the slides properly. Boy, I thought I did. And also information on some tax breaks. So you just have to fill out a form on our website and we'll email you a link to the ebook. And we'd be happy to demo our software and service and talk to you one-on-one. And now, Mike and I would be happy to answer any questions that we did not answer. Okay, here's a question. What if a child wants to go to state college and private is cheaper? How can you lower the cost for state college in New York? That is difficult. Because most of the state colleges are really very formulaic in how they price. So New York, in my experience, is not particularly, first of all, New York colleges, SUNY colleges are a bargain anyway. They are actually cheaper than many other states, in state or out of state. But SUNY colleges, you may qualify for the Excelsior scholarship if you make less than $125,000, I believe it is. That just reduces the tuition, but you still have the room and board part, and you may be eligible for grants, but that's all based on your income and asset situation. The merit aid is really there's a little bit, but there's really no way to make it cheaper. So if you're not getting needs-based aid, of course you can look for outside scholarships. So sorry, I don't have a good answer for that.
So Linda asks, can you give an example of how to calculate 5.64% of parent assets?
No, not easily. When you go, you actually need software for this stuff. Because the formulas are rather complicated. The 5.64% is, I believe, over an allowance, and I'm not sure what the allowance is. But so So no, I can't really give you an example, but I'd be happy to you know, plug it into the tool, and then I might be able to come up with something. By the way, there are calculators which vary in quality on the college's website usually. A lot of them are not very high quality, but you may be able to get an idea from those. Um, can you talk more about how NJ class and UMass aid works? I think you're talking about the loans. Um, or are you specifically talking about UMass? I'm not sure. Um, so the NJ class loan is a state loan program. It is not that different from private loan programs, except that it's given by the state. And Massachusetts has a similar loan program, um, which which I think is also given by the state. Um, so you apply, you do in the New Jersey case, you have to have filled out the FAFSA, and then you apply for the loan through the NJ class website. And for UMass, I believe I'm not sure if the FAFSA was required for UMass, but it is a similar process where you apply through the website. You apply for the federal loans, by the way, through the financial aid office at the college. So these state loan programs are a little bit different. You're applying with them directly.
I can add also that my younger daughter attended Montclair State for a graduate degree, and we didn't proceed with this, but we looked at the NJ class loan application. And a prerequisite as well is that you apply for federal student aid before New Jersey will consider you for federal student loans before New Jersey will consider you for the NJ class loan program.
Yeah, you have to have filled out the FAFSA. I had a client do that loan for this school year and was very happy with it. Okay. Any other questions? Um, okay.
Okay,
Well,
Andrews, thanks for your comments. We hope this has been informative for all of you, and please feel free to reach out to us once this is over with any further questions you might have.
yeah. We've been doing this for a couple of years, so we have some experience. Unfortunately, it's always new every year, because the colleges change a little bit in what they're doing, and the rules change. We unfortunately have the Department of Education delaying the FAFSA again, and that really does put a wrench into the process. And last year, not only did they delay it, but it was full of errors. I think only one of my many clients went through it without any error. So the errors caused all kinds of problems as well. Hopefully, they finally got it right this year when they release it December 1st, and at least maybe there won't be any errors. Um, but I'm sure you folks have read what they've done on the student loan side, but that's a mess as well. So it's a difficult process right now. Okay. Feel free to reach out to us, get the ebook. We will be sending out the slides, and once we process the recording, we will send out the recording link as well. And I wish you all a good evening.
All right, thanks very much, everyone. Have a good evening.